In Tokyo, a head and shoulders doesn't mean you need a dandruff shampoo. In Mumbai, a double top isn't two horns on a bull. In Frankfurt, a double bottle isn't a plumbing disaster. And in New York, a bearish engulfing isn't a scene from a nature documentary. There's one language that connects every trader on every desk in every time zone. It's the visual language of fear and greed and, oh, I definitely should have a stop loss. It's the charts. Welcome to Traders of the World, the only show fluent in the native tongue of the market. I'm your host today, Flávio Lemos, and joining me is our esteemed co-host, Enrico Cozzolino. He's a CVM registered fund manager, asset manager, and a CNPE certified analyst in Brazil, whose career began in 2008. He brings extensive experience from both the buy side and the sell side, having acted for major banks and asset managers. His focus is always on investment strategy and customizing the perfect product to meet the client's objective. Additionally, now he's an author like me, author of the book Rich Son and Poor Father, in Portuguese, Filho Rico de Pai Pobre. Rich Son of Poor Father just launched, and he's a frequent voice in specialized finance and media. Hello, Enrico. How are you?
Hi, Flavio. It's a great honor to be here. I'm sure that people watching us will enjoy this conversation. Sowmi has a lot to teach us, to share. He has a great experience to share with us. And also to thank you, Flavio. You have done so much for the trading market here in Brazil. I want to take this opportunity to thank you on behalf for those as me, passionate about technical analysis. You have done a lot for so long here in Brazil, and thank you for this opportunity.
Great. All right, Tim, before we dive in, the ritual sacrifice in the YouTube algorithm, if this chat deposits any value into your knowledge account, smash that like button and subscribe, please. So, they say trading is an art, but today's guest proves it's also a rigorous science. Imagine applying the discipline of a PhD in a chemical engineer and the pressure of institutional oil trading to the stock market. That is exactly who we have with us today. He spent 35 years at energy giants like Mobil and ExxonMobil, including 8 years trading oil in the Asia Pacific. He holds an MBA, a PhD, and the prestigious CMT designation, as Enrico and me have. So today he runs a SK Market Insights, where he uses sophisticated volatility framework, analyzing the VIX, the VVIX, the volatility of the VIX, and term structure to tell us exactly when to enter and when to exit. So it's a pleasure to welcome Sowmi Krishnamurthy. Sowmi, welcome to the show.
Thank you, Flavio, and thank you, Enrico. It's a real pleasure to be on this show. I've heard a lot about your podcast and watched some of the previous distinguished speakers. So I'm honored to be here and to take your questions.
So here's the plan. Grab your coffee, make it a double, and focus. Right after the intro, we are going to open the Pandora's box. Don't go anywhere.
You ever wondered what truly connects traders from Tokyo to London to New York? You just need to learn the language. That language is technical analysis. Understand its signals, and you'll understand the world. Welcome to Traders of the World. Here we skip the jargon and just figure it out together.
Namaste. Go on, Enrico.
Well, from molecules to markets, some of your background is fascinating. You have a PhD in chemical engineer and spent more than 35 years in ExxonMobil. I want to know, how does the chemical engineer look at a price chart? How is it differently from a standard finance professional? Do you see market volatility as a form of chemical reaction?
Yeah, thank you. Good question, Enrico. And many people ask me how I made the switch from one to the other. What I would begin by saying is that engineers in the main deal with data. Our life runs on data. We use data for everything, for design, for manufacturing, production, everything runs on data. And so we look at data, analyze data, and make decisions based on data. And technical analysis, is a little bit like that, where we're looking at evidence-based decision making, where we look at chart patterns and various types of indicators to tell us, where the market is going. So, in a way, those skills, and that's one skill. The other skill I would say is the discipline it brings into the field. So to be a successful trader, one needs to be very disciplined in the approach, and so you have to have a plan and then execute the plan. And if the plan doesn't work, you have to withdraw from the plan quickly. And these are mechanical movements which you have to make without too much emotion involved in those decision making. So that's where I think my engineering background helps. The other part that you is a very good question, is about volatility, and I went back and I asked my Perplexity agent what volatility meant. So volatility in the chemical field means volatile substances vaporize very easily, so they agitate a lot more, and so you open the lid and you boil it, and they all go up into the air. So very volatile compounds vaporize easily, and so very volatile markets move much faster. So in a way, you can say there's an analogy, but it's a different type of analogy. So that's how I would frame it.
It's a different reaction, no? So you spent 80 years in oil trading roles in the Asia Pacific. So the physical commodity trading is a different kind of piece if you compare that to screen trading equities. And what was the most critical risk management lesson you learned in your career? And what this teaches you that you can apply to the S&P 500 today?
Yeah, good. What I would say is physical trading of commodities doesn't generally happen alone. There is an element of futures market that is involved, whether it is swaps or on exchanges. So commodities traders will necessarily look at both the physical and what we call paper. Generally, paper, translates into options and futures and derivatives and so on and so forth. And to give you an example, you see cargoes of Brent crude oil coming from Europe to the U.S. At least when there's a need, and that is driven by disparity in prices, called also referred to as arbitrage. And in order to lock in the arbitrage, traders would generally act on the futures exchange and lock in the arbitrage, and then convert that into a physical transport. So essentially, the two are work hand in hand, and a lot of activity that happens in the futures market has an impact on the physical. So the physical is basically, in the business we call it cash. So the cash markets and the forward markets are all connected, and what happens in the cash has a bearing on futures and vice versa. And yeah, please go ahead, Flavio.
No. Oh, please complement your answer.
Yeah, the last piece of the answer to Enrico's question was what was the risk management techniques that we use, and what is the most important lesson learned. I think the most important lesson learned for a trader would be to preserve the capital that we trade with. So once we lose the capital, we're out of the game. So the key is, regardless of what we are trading, risk manage and size the positions so that we can all live to play another day. So that's the same thing in commodities too, and particularly with futures. Futures has a higher risk, much higher risk than equities, I would think, and so one has to be extra careful in playing those markets.
One of the precious lessons.
Yeah, the oil market is very liquid. So let's get into your core expertise. That's why the show is about.
Okay.
So most people just look at the VIX and say fear is high or fear is low. Your company, SK Market Insights, analyze the VIX, the VVIX, and the VIX futures term structure together. So can you explain to the audience how these three interact? Why isn't the VIX enough on its own?
Sure, very good question, and that's what I beat the drum on mostly. And if you have my first slide, and you can throw it up on the screen, that might help in understanding.
Do you want to take and show your screen, or do you want me to do it?
I let you do it because I'm not equipped to do it yet. If you can throw up the first chart,
Okay.
So let me carry on by saying VIX by definition is the 30-day implied volatility of S&P option. So basically what it does tell you, what is likely to happen with the S&P prices over the next 30 days. But if you want to look beyond that and see what happens in the next 60, 90, 120, and so on, 180 days, we essentially have to look at the VIX futures. Now, VIX futures are also actively traded, unlike the VIX, which is not traded. And VIX futures and the curve of the VIX futures gives us an indication of what the market structure tells you about future expectations of VIX prices. And the VVIX is the implied volatility of the options that relate to the first two VIX futures, and there is a formula that CBOE, Chicago Board of Options Exchange, uses to compute that. It's all online, and one can look it up. And it's also referred to as the VIX of VIX. So that gives you an added dimension of what is happening in the market. Basically, it is data, more data available to make informed decisions about where the market is going. So, for instance, the term structure can be upward sloping, or the term structure could be downward sloping. And in markets that are very volatile, you would see a downward sloping curve, whereas markets that are conducive for rallies will have an upward sloping curve, and that basically tells you what is likely to happen beyond the 30 days. Yeah. So number two shows you, the Trinity, and I like the word you used to describe that, Flavio. So I've kind of adopted that language. And
next question. Volatility now is an asset class. And so how technical analysis could be applied to enhance favorable outcomes in volatility risk premium capture? Could you give us an example?
Sure. The volatility is something like a rubber band. It can extend. Implied volatility can expand and contract. So in the business, what we see is, for any particular asset class or any particular individual stock or share, you see it has an implied volatility, and it also has a historic volatility. So when the implied volatility explodes over the historic volatility, those are excursions that generally don't tend to last very long. So that provides an opportunity because volatility is mean reverting. So you have an expansion in implied volatility to the upside or to the downside, and then it reverts back to the mean. So these are opportunities to capture volatility, and that is referred to as the volatility risk premium capture. So you could effectively apply it to any asset class, and just based on the price movements you follow. If you have a big down day, for instance, in copper, as an example, copper prices, just collapse, and then and the prices reflect that, and then you would see in the options market the implied volatility of the nearby copper options will expand, will become much higher. And the belief is that once it expands, it doesn't stay in that elevated state, but it comes back to normal over an extended period of time. And so the risk premium capture is an opportunity to play volatility as an asset class, as opposed to trading a stock for market direction.
It's a very, very clear example, Sowmi. And I have a question. You have a specific methodology for breaking down the market into rally and correction periods, okay? So could you share your screen again and show us a chart of S&P and with your indicators of volatility, and how do you visually identify that sustained rally has begun?
Yeah, thank you, Enrico. Good question. So what I've done for here is to show you, this is the, on the bottom is the S&P 500 chart, weekly chart. And on the top, we have, for the period April through November, which is this entire rally period following the tariff reset. Okay, so we had the tariff reset on April 7th, and then the market has since rallied. So you can see this and S&P prices at on the bottom screen. But on the top, I've charted for you a three-dimensional view of the term structure, which I described to you earlier, where we have charted the first 6 VIX futures against time. So when you look at the chart, you can see the blue indicates values between the 20 to 25 range. The green indicates values of the futures from 25 to 30, and 30 to 35, and 35 to 40. So we had an excursion at that time of the VIX futures, which flipped from upward sloping to downward sloping with a peak value of somewhere around 40. And that is captured here. And so when you see a movement like this, these are conditions that happen during market corrections. And so you wait for the market to return to the term structure to return to a downward sloping curve, so that those are the kind of situations where volatility has returned to normal and the rally continues. So with that, you can see, comparing the top and the bottom chart, the dip in prices, they may not be exactly aligned between the S&P and the three-dimensional chart, but you can take it from me that that dip that we saw on 7th April is really exactly when that peak occurred on the three-dimensional chart of the term structure, showing the orange peak. Yeah, exactly. And so then once the fear subsided, because at that time when the tariff news hit, people didn't know what to make of it. And they were not sure whether this tariff would be a long-standing impact on the markets or a short-term impact. So when you see a movement in the term structure like this, where it goes from an upward sloping to a downward sloping curve, that means the market is very uncertain about the extent of the impact of the tariffs. But once things became clear in May and then in June that it wasn't going to have such a long-standing effect, and companies were going to absorb some of the costs and so on and so forth, and deals were being struck with many countries individually and severally. Then the market returned to the blues, as you see further on the right. And those conditions generally promote a rally. And you saw the market rally with that.
Okay. So I have read about your analysis of the 7-day movement of VIX and VIX futures term structure deviation. That sounds complex but powerful. Using a chart, can you show us that what favorable rally condition looks like in that specific deviation model? What's the signal to pull the trigger?
Yeah, that's a good question. Very good question. So if we could go on to the next chart, I'd like to show you. So what we have in the previous chart is the movement of the term structure with time. The curve went from upward sloping to downward sloping. So in my work that I've done and developed this tool, what it does is it takes the term structure and makes a linear approximation so that every curve becomes one dot. And so we measure that term structure against a reference. And that reference is what we call the threshold. So just read VRS as being the deviation of the term structure from a defined reference during rally conditions. So when the VRS starts to move against the reference, then we know that the slope of the curve is changing from upward sloping to maybe more neutral or downward sloping. So by choosing to compare the VIX versus the movement of this deviation, which we call the VRS, you can define the movement into 4 regimes. So I'll start with the lower left-hand corner on the left side. In regime 1, we have VIX below a certain threshold, where in the threshold is a long-term average of VIX, let's say 15 or something like that. And the VRS, the deviation of the term structure from an ideal reference for rally conditions, is also below the threshold. And this threshold for the deviation is measured as the shift from a upward sloping to a downward sloping. So you've got 2 references, one for a VIX threshold and one is the deviation threshold. So when the deviation threshold is low and VIX is also below a threshold, those are ideal conditions for the rally, like you saw in the previous chart in blue. Now we go on to the next box on the lower right, where the regime 2 describes VIX is above a threshold, but the deviation from the ideal conditions for the term structure is above the threshold, is below the threshold, but the VIX is above the threshold. So VIX has moved on to 17, 18, or 19, and so on and so forth. But the term structure is still below the threshold between upward sloping and downward sloping. So when you get into a situation like that, what that is telling you is VIX is active. People are concerned about what's going to happen in the next 30 days. But the term structure is telling you longer term, they're not that concerned because people are not seeking protection along the futures curve, because it might be a case where this thing will die down in the next 30 days and things will be back to normal. Then we get on to regime 3, where VIX is above the threshold, but now the deviation from the reference structure is also above the threshold, which is going from a upward sloping to a downward sloping curve. And that's what you saw in the previous chart marked in orange. And that basically tells you that, these are conditions where you want to stay out of a market or choose an opportunity to enter the market as you wish. So the 7-day movement tracks where the VIX is against the deviation from the reference. And here in this particular chart on the right, you can see it's regime 2. And it's the dots are supposed to be read as blue dots. It showed up as gray dots. Basically, what has happened is the VIX and VRS, VIX has moved above its threshold, but the deviation from the reference structure is still below its threshold. So it's a sort of a gray area where it could go either way. When, and I'll show this to you in a later chart, when...
Olá, espero que esteja gostando da entrevista. A Trader Brasil foi eleita por 2 vezes no Rank Awards 2024 e 2025 como a melhor academia de formação de investidores do Brasil. E ela tem um presente para você que está assistindo esse podcast. 10% de desconto, é só usar esse QR Code que está aqui embaixo e a gente te espera lá, ok? Agora não esquece de dar uma moral pro Flávio. Curte, compartilhe esse vídeo e se inscreva no nosso canal, ok? Até a próxima e obrigado pela presença. Valeu!
When things get decidedly worse, what happens is VIX still goes up and the deviation from the reference structure still goes up even higher. So both are moving in concert. And you got a curve of the term structure, which is downward sloping, and VIX is very, very high, like 40, as in the case maybe in the last slide.
Okay. About this structure, which strategy could fit best on this regime 2 scenario?
Yeah, that's a very good question. I think what this helps us decide is when the dots are in the regime 1, basically it's smooth sailing. Volatility conditions in the near term and the longer term are quite low. That promotes rally, so the market keeps rallying. But once it starts to move to regime 2, you have to take notice to say VIX has moved, but the term structure slope hasn't shifted much. So it may be a case where you have corrections and uptrends, where VIX moves, but the term structure doesn't move. And these may be opportunities to add to positions in a rally. But you have to take note that it's in an intermediate sort of state between a smooth condition in regime 1 and maybe a volatile condition in regime 3. And so one necessarily has to take protective measures or add to positions depending on how you see the movement in that 7-day chart in that period. Sometimes it can be just a movement or a correction in an uptrend, and you can add to positions. But sometimes when they move in concert and they move to the regime 3, then I think it may be wise to lighten up on positions. And in the extreme, when VIX goes really high and the term structure is downward sloping, then there is a good argument to be made for entering new positions. Because a lot of the, like for instance, as an example, on April 7th, when the market bottomed out and people who were brave to take a position on that day or the next day would have benefited handsomely in the subsequent rally.
So getting your answer here in April. So April, we were here.
Yeah.
This at this which was the regime in this at this point?
So if you look at that, you can see the green and the blue and the peak, which is in orange, and that would be regime 3.
3. Okay. So we were here.
You were on the chart, yes.
So that's the best scenario of the VIX to open new positions.
Well, it depends. Yeah, so hopefully before it got to regime 3, you either took a hedging position or liquidated your existing position. But if you're setting up a new position, those are good opportunities to get into new positions.
Okay, I see. Okay, so it's not just indices. You can apply technical to single names too. You have a case study on your site regarding Archer Daniels Midland, ADM, broker house. So
Yes.
could you walk us through a stock setup like that how do you combine standard technicals with your volatility overlay to time entry? You got
Yeah.
your slide here.
Sure. Yeah, you can see on this particular chart, I was looking at the weekly price action of ADM, and I was, accidentally browsing through these charts, and I came across this double top, and I did some calculations to find out that the neckline was decisively broken, and you can see that huge gap in the middle of the chart, which led to ADM testing its lows. And sure enough, the distance from the peak to the neckline was exactly the same as the distance from the neckline to the lowest low. So that is a classic head and shoulder, double top pattern. And then once it happened, the market rallied from there. And you can also notice a change in structure, because it looked to me like a 5-wave Elliott wave impulse pattern that developed from that low. So how do you take advantage of this using volatility? On these single stocks, you don't have data readily available on futures and term structure and things like that. But what can come in handy is the Bollinger Band width, where you look at whether volatility has expanded or contracted, and you can see a number of locations where the volatility has come down to the baseline. And just before the market took off on that 5-wave sequence, you can see volatility, the bandwidth narrowed somewhere around, somewhere around there, and then expanded. So you can play volatility through that as well, because understanding that the market has met its downside target, and you've got a situation where the volatility of the stock is quite low, that usually helps you to decide whether you want to take a position in buying implied volatility and riding that wave up to the 200-day moving average, or you can go outright a stock and with a stop loss underneath it.
If we look through the market right now, November 25, looking at the volatility dashboard that you have, what's the term structuring telling us? We are in a safe zone for a rally, or are the warning lights flashing?
That's the $1 million question, isn't it? So let's take a look at. I tried to do my best and prepared a chart for you to compare, because sometimes you get some meaningful indications from drawing these charts. So these charts, they're basically an extension of the 7-day chart that we showed earlier. So the chart on the left, Flavio, is the one you asked what happened on April 7th, right? That's the period around April 7th where it had gone to regime 3. Both VIX was high and the term structure had inverted into a downward sloping curve. And on the right, you see what has been happening in the market since the beginning of this month. So we had, for instance, ideal conditions at the bottom left of the right-hand chart, where VIX was a bit elevated, but the slope of on the right hand side, the next one, right, where VIX was a bit elevated, but the term structure hadn't moved as much to say there was a long-term concern. So the concern appears to be more of a short-term concern initially, but then it gradually moved to the right to a neutral condition. So I would say that given the length of time where it had to react, and it has not, the slope of the structure hasn't moved from upward sloping to downward sloping now, you can sort of gather that, maybe this is not as serious a concern as it was in April 7th. Another way of looking at it is, suppose if you take the left chart and draw a vertical line at, say, 25, and then you take the right chart and draw a vertical line at VIX 25, you can see, for instance, once again, that while VIX is in 25 in both cases, the term structure reaction is more muted on the right than on the left. So saying that the term structure is not as reactive to the move in VIX as it was in April. So these relative charts help you understand that the current circumstances were not just as bad as it was deemed to be in April, when the whole tariff hit us on one day overnight with the news that tariffs were going to be charged. But this is more of a progression, and also a number of other factors came into play here, because a lot of the activity that we've seen in this correction recently as related to the Mag 7 stocks and also the questions about AI and its monetization and the amount of dollars spent where the market might be legitimately concerned about the payout of those investments. Whereas the rest of the market, when you look at the earnings and the earnings beats and all that, the earnings season didn't come out too badly, given the tariffs are starting to sink in, and so the market is taking all that into consideration.
Okay.
And therefore it's saying, hey, look, guys, it's not as bad as when tariffs hit us in April. Yeah, there is a concern, but the concern may be more short-lived as we get more clarity around, how much money is going to be spent on AI and what they have to show for it. And so it becomes a subset of a bigger concern affecting only a subset of issues.
Sowmi, I know that you are an avid golfer, and in golf you can hit the perfect drive, but putting the hole with the bad putt. In trading, you can have the perfect entry, but ruin it with a bad exit. How does the discipline that we have to have in golf translate to your patience in waiting for the right volatility setup?
Yeah, that's a good question, Enrico. I think they have another saying in golf, which is drive for show and putt for dough, putt for money.
Yeah.
So it really is a matter of, keeping the discipline and staying on the fairway and getting the putt in that wins you the prize. So there's a lot of discipline involved in staying the course and executing to completion. So starting a position and feeling great about a position rallying is fantastic, but watching that position, adjusting the stops, and making sure you harvest those profits is really what you can take to the bank.
Yeah. Sowmi, this is the question we ask every guest. You have had a long career. What was your best call or best trade where the engineer, the macro, and the charts align perfectly? And conversely, what your worst call, the one that humbled you and taught you a lesson that you never forget?
Yeah, very, very good question, Flavio. I think what I would say is I'd start with the good news first, and I'd say a lot of the successes that I've had is in the commodity markets, but not just trading futures, but trading commodity-based ETFs and things like that, where I give you an example. In early 2022, just before the Ukraine war, the markets rallied big time. Oil rallied, and agriculture rallied, and there was a concern about lack of food supplies and so many things. So that was a good rally that I was able to catch. And of course, I'm careful not to mention any of the work that I've done as a trader in the oil markets, working for ExxonMobil, simply for proprietary reasons. I like to stay away from that and just talk about my own trading activities. So I think that was a good example of a rally that I was able to catch, and it was a success story. My worst trade, and there have been a few, So it's not just one or two. But I tell you, the biggest disappointment I had was very, very early on. I took a position in WorldCom. And you know what ultimately happened to WorldCom. And I believed naively at that time that things would turn around and WorldCom would come back. And then, it was a good lesson for me that, stocks can go to zero. Right. Many people think it may not happen, but it has happened, and it has happened again and again. But that points to the importance of setting a stop loss and saying, look, I need to be here to play tomorrow, so I'll set a stop, and that's my pain limit. And never mind if it just turns around and rallies and goes back up, I'll take it as a lesson. And then because there could be, reversals too. But that was probably my worst investment decision.
WorldCom, Enron, a lot of fraud.
Yeah, so many of them. And there was this private equity firm called Oxif that met a similar fate. And then you had Digital Equipment Corporation, which DEC, under the trade name of under the ticker symbol of DEC, DEC, that also went out of business. And so, and I think, going forward in this technology-based, fast-paced movements, the life expectancy of a tech company has become much shorter. So one has to be extremely careful because, as we are seeing now, with the example of Oracle was a darling last month, but it's a different story. So you got to be extremely careful in this space, and also with the risk management techniques on these individual issues.
A lot of good. Let me compliment, please. A lot of good people lost money with several stocks, and this is an example of Isaac Newton. He was a very talented guy. So I love this question about the worst trade, because even the most intelligent people lose. So you need to have stop loss. You can watch this chart. He was buying South Sea, the name of the stock, South Sea stock. And Newton invests a bit here. He has its happy here. Newton's friend gets hit here. And so he got the fear of missing out. So he enters with a big lot right before the top. And then Newton is its broke here. So that's, even the smart people lose money. So that's why and you have to have a stop loss settle.
Yeah, or mitigate the risk somehow. If you want to play in those markets, options provide a good alternative, because what you lose is the premium you put in, and you know what you're going to lose. And provided the implied volatility is low, you catch the volatility when it's low. So you're buying low volatility and selling high volatility. So you will get that extra kick when the prices explode. Like, for instance, take an example. Let's say in NVIDIA, if you bought the options at a low price, long range options, long dated options, and you hung on to it, the gains are exponential. So you can benefit with limited downside risk in those situations.
Well, this has been a masterclass in risk. Where can our audience find your research, your volatility updates, and learn more about your market insights, Sowmi?
Sure, Enrico. I have a site called skmarketinsights.com. I blog from time to time, and sometimes when I see interesting things, like the ADM is a good example, and before that I think I may have written a blog on Disney and playing implied volatility to your advantage in that. Those blogs are totally free. Anybody can access them. You just have to go to the site and look for the blog, and whenever I post a blog, you're welcome to read them. And if anybody specifically asks to be copied on these blogs before I post them, I'm happy to put you in copy on a circulation list so that you know that I posted a blog, or I can even send you the blog directly. So it's open source, really. So you're welcome to access whatever I have on that site.
Okay, Sowmi, thank you very much. Your ability to treat market risk with the precision of an engineer is exactly the kind of kind of edge our listeners are looking for. Thank you for sharing your charts and your process.
And thank you for the opportunity, Flavio, and thank you, Enrico, for all the great questions that you asked. I think we can go on talking about volatility, but in the interest of time, I think it's a good time to stop here.
Okay, thank you, Enrico. Thank you.
Yeah,
thank you,
thank
Flavio.
you very much.
Thank you, Sowmi. It was a
Thanks.
pleasure.
Thank you. Thanks to both of you.
So that's all for today on Traders of the World. A big thank you again to Sowmi and Enrico. Until next time, watch the VIX, check the term structure, and keep your risk managed. Take care and bye-bye. A big party here. My mother-in-law made 80 years old this year.
Wow.
So mother-in-law, you need to go. You know, né?
Yeah.
I will have a problem if I went to Dubai.
That is true. So true. So.